All right, guys. We live, right?
We're live, man.
We're live.
Awesome, awesome. Hey, guys, this is Dr. Noel Liu here. One thing we are going to be discussing today is what is our biggest expense as professionals? We as dentists, as high income earners, what are we looking at? And the answer is taxes. And with that being said, we are going to be diving in some of the strategies that we're going to be talking about is how do these other guys, these big boys, how are they going around and getting those tax breaks, tax, like not paying taxes, paying minimal taxes. So we are going to be discussing some of the strategies today, the top three, and we're going to dive right in. Jonny, let's start with you. Hey, Jonny, on
Can you
mic.
hear me? Hi,
Yeah,
can
now
you
I
hear
can
me?
hear you.
now.
Okay, good. Thank you guys all for being here. I'm Dr. Jonny Withanachchi, or Dr. Jonny Walker, as my social media. I've been a long time multifamily real estate investor for the last 4 years. I've created a capital firm that's invested in over 650 apartment units and over $90 million of real estate in transactional volume. I'm here to try to add value. We're trying to help this group get a lot of
Awesome.
insight. And yeah, we're ready. I'm ready, man. Let's go.
All right, good deal. And Tom, let's go.
Hey, great to be here, guys. So excited for today's topic, actually, tax strategies. And my name is Thomas Bibi Varghese. I am a serial entrepreneur. I got connected with these amazing dentists, Noel and Jonny, and we invest in real estate. I'm invested in about 1,000 units combined as a GP and an LP. And there are some investments that I'll be getting involved with soon too. So we have done quite a bit of investing in the last couple of years, and we wanted to just simply educate everybody, share what we know, and get the group ready for
Absolutely.
investing and be here as a resource.
Hey, I would just like to take a few seconds just to welcome some of our new members in this group. And it's really, really an honor to have you guys in here, and also an honor for, us and yourself, so that you can learn and exchange ideas. Now, talking about taxes, let's jump right in. Guys, I know we want to kind of keep it within the hour. We will have Q&A and we will discuss a lot of things here. But the first thing that we would like to go on to and dive right into is something called bonus depreciation / cost segregation. Which one of you guys would like to take a shot at it first and just kind of go over what it is and how does it work normally?
Well, Jonny, did you want to take that?
Yeah, I mean, either one. I mean, how about I'll talk a little bit about what just regular depreciation.
Yeah. Let's start with regular
Let's
depreciation,
start
what it
basic,
is and how long.
This is the reason we want to talk about bonus. This whole topic is that the 100% bonus depreciation ends at the end of this calendar year. So that's why we really want to spend some time and dive in a little deep into detail a little bit, just so people understand exactly what it is and how it may vastly benefit them. So a standardized depreciation is essentially a deduction that the IRS allows you to take whenever you buy real estate. Depending on the type of real estate. Certain types of real estate is deducted over 39 and a half years, like office and stuff, office, industrial. But multifamily real estate, on the other hand, is we're able to write off the entire property in a 27 and a half year time period. And what that means is if you were to buy a $27 million building, for example, the IRS would allow you to have a deduction of $1 million per year, assuming that the entire amount is depreciable. But the IRS allows you to depreciate the building, not the land. But so let's just keep it simple. If it was a $27 million building, they allow you to take a $1 million deduction per year to as depreciation. So the building obsolesces over time. So the government says, all right, well, it'll take about 27 years for it to go to zero, and then you'll have to build a brand new building. So we're going to allow you to depreciate. So what that allows you to do is take a $1 million deduction per year. And that offsets any passive income that you may have gained from, or other real estate gains that you may have had, and it can offset that $1 million. So if you make $1 million and you make cash flow from your properties, and you have all this cash flow coming in, now you can use that deduction, that $1 million, to offset some of that, some of the gains, or offset all of the gains. So you don't pay taxes on your gains.
And why is that important, that, you know, when we talk about like the length of time, like 27 years, and is accelerated to that 1 year, why is that important?
So I mean, Tom, if you want to go into that a little bit, yeah. So we can accelerate that, right? From, instead of 27 years, and that's what, through a cost segregation analysis. I'll let Tom, you know, if you want to go into that a little bit.
Yeah. So Jonny, you explained it very well, actually. So exactly, one of the main advantages of anybody wanting to invest in real estate, not only the returns, but one of the main things is the tax advantages, right? So basically, Jonny said this last time we did this. Most of the 90% of the millionaires in the world are created through real estate. Okay, and they take advantage of tax strategies. Tax is your number one expense, but especially when you're in a high earning bracket, you are paying a ton of money in taxes. So real estate allows you to depreciate or take off money from your taxes rather than giving it to IRS. So what Jonny said was, in 27 and a half years, right, you can depreciate the entire value of that property over a period of 27 and a half years. But however, in 2018, the law was passed by the Trump administration that in the next 4 years, 2018 through 2022, you can take that depreciation that you could take in 27 and a half years in the first year. You don't have to take it year 1, year 2. You can bring it all forward and take it in year 1. Guess what that does to somebody who's earning a lot of money? They will be able to take that huge chunk of depreciation as a deduction from their taxes. That simply is what is called as accelerated, or also called as bonus depreciation.
Absolutely.
Simply, you're just bringing it to the first year.
So guys, talk a little bit about this cost segregation. What does it involve? So let's say we bought a property, and what are we doing in order to offset those taxes? What are we doing, like changing carpets? What is it, like, you know, appliances? Like,
sure.
You know, just like get in a little bit, just so that, you know, everybody can understand, like our audience can understand, like what are we
what
talking
cost
about?
segregation is. Yeah, sure. So instead of like Thomas was saying, instead of depreciating over 27 years, you can accelerate that depreciation, so you can take more losses on the front end, or more deductions on the front end, which reduces your taxable liabilities. So when you're buying a multifamily real estate building, you're buying really 4 things. You're buying the land, you're buying the building, you're buying the land improvements, you know, pipes, sewers, waterways, and you're buying the contents of the building, right? So the contents of the building,
light fixtures,
not anything not
cetera,
part
right?
of the actual physical, nailed to the physical structure, can be depreciated faster, and that's called a short life property. So short life property, because the IRS recognizes that, for example, furniture or blinds, or, you know, any carpets, all of these things have a shorter time shelf life than 27 years. So what they say is they allow you to write off short life property in 5, 7, or 15 years, depending on what it is. So anything from paving, the parking lot can be done in 15 years instead of 27 years. The landscaping, the blinds, all of that instead can be pushed to the first year. And then, you know, like that's bonus depreciation, right? So
the question would be,
oh, sorry, I shouldn't even gone into that. Cost segregation is, so now you can take blinds, instead of depreciating over 27 years, now you can depreciate it over 5 years, for example, right? Mm-hmm. So what that does is, if you have a $2,700 set of blinds, instead of taking $270 per year for 27 years, you can take that $2,700 and divide it by 5 and take more per year, right? So what you can do is you can take all the contents of the building, break it down into its components, and depreciate that faster. And you can do that through a cost segregation analysis. And you have to actually hire a firm that'll come in, and
Mhm.
it costs a lot of money to do it, upwards of $20,000 to do it, depending on the size of the property. But it allows you to now, instead of standard 27, it allows you to do it in a shorter time period. So that's cost segregation, right? And then, of course, what Thomas is talking about in 2017's the Tax Cuts and Jobs Act, right? That now said, instead of dividing it by 27 years or 15 years or 12 years or 5 years, now what you can do is take all of those losses in year one. You can take 100% of the short life property and deduct it from year one. And
So
what
let's
that
talk
does, it
about
gives you
let's
a
talk about
huge negative.
how does it
sorry?
affect a passive investor? So if I am an investor, I have no clue, never invested before. How does it affect me? Like if I'm going to be taking and say, hey, I want to invest something here, how does it affect? How do we do it?
Right.
Into the return.
You're saying, okay, so now what that does is, so now, for example, if you're a passive investor and in a syndication, for example, and now I invested $200,000 in a syndication. In that syndication, I got a cash flow of $16,000 over that year. Now that $16,000 would flow to ordinary income, and I would be taxed heavily on that at the same rate as ordinary income, which I'm taxed at the highest rate. Or I can get the losses from the real estate. Now we have these deductions that are only paper losses. They're not actual physical cash losses that now can offset these cash that I got. So now all of a sudden my passive income of that $16,000 is not taxed. There's no income tax, at least at that time, right? You push that tax down the road. You kick that tax down the road. And also what it can do, if you have gains from others, maybe you have a syndication that matured and you got a big chunk of money back that you would be otherwise taxed on. Now you can take these excess losses from here and use it to offset other gains from real estate and so you can pay less taxes on those gains. So you can so it allows you to take losses that don't exist and offset income from other real estate.
No, that's great. That's a great point. That's a great point. Now, is it fair to say that if it's a passive income, it's a different tax rate, or would it be the same as our earned income? Because a lot of people are kind of confused, like, hey, if that money, if I'm not touching it, it's just coming in passively, would that have a different rate? Because everybody has taxes in their minds, right?
No, that still would flow through a K1 and it would flow through it to ordinary income. So if you didn't have any type of tax laws, you're still going to get taxed at the highest rate. But the thing is, with syndications and in real estate, you have depreciation built in automatically. If you don't do a cost segregation, you're still going to get 27-year deduction on all. And so you're going to get divide the property value or the building value divided by 27 years. You're going to get a loss every single year. Every year that you own that real estate, right? It's a beautiful thing.
Yeah. What I did was, while you were talking, I just was, since it is almost, the tax deadline is approaching, I had to look at my K1 yesterday. So while you were talking, I pulled up one of my K1s so that I can show you actually. Can you guys see that? But is it like flipped over?
I
It's
think
backwards.
so.
Can you?
Yeah.
Let me just flip the camera actually. So
what does it say? What is it showing? That you got gains and then it shows up as a negative number, right?
Yeah. Does it show now?
Kind of. Yeah, negative 128.
Yeah, negative 128,944 of what I invested was 200.
And that was this year.
That was for 2021. Yeah.
So bonus depreciation. Look, Chad, with the bonus depreciation, he has a negative 128.
128. So that is, I'm going to take that and apply to my
so let's
gains
clarify
from
this,
another
Tom.
investment.
So
Beautiful.
you put in 200K, you will get your capital back, 200K, and any gain over up to 128, you will be tax free. Is that correct?
Zero. Yeah.
Zero taxes.
Okay.
Yeah.
And
And
based on other factors, you could, again, check with your accountant and all
CPA,
that.
always check with CPA. Yeah,
Always check with your
tax
CPA. You
professionals.
could probably take it off of your income. Again, check with your CPA and all that. So that's like a huge deal for me. So when it comes
No,
tax,
so,
that's a massive loss that you can. Yeah, I mean, this is
yeah.
so.
so all
Let's
you guys, I mean,
take a look at this
yeah.
example, right? Say you take buy $1 million building, right? You put $250,000 down to buy it, take $750,000 loan, and then you can take short life property is estimated to be about 20 to 40% of the value of the property. So
Right.
say 30% of it we can take depreciation day one.
Yeah.
So 30% of a $1 million building is about $300,000. So we can take a $300,000 deduction day one, and the down payment was $250,000. Got a free
Mhm.
building,
Yep.
right? You pay nothing for the building because you
Yeah.
got the
You will.
loss right from day one, and that ends at the end of this year, guys. 100% bonus depreciation ends end of this year. So take
So,
advantage of it if you can, right? So
so I
that's
just
that.
want to, I just want to spend a few more minutes here. So, as a passive investor, somebody who invests $100,000 right now, they put in 100K before the end of 2022. Now, does that mean that every single depreciation that cost seg has to be done this year, or can it be taken? Because those are some of the questions that somebody had, and I just wanted to kind of like pick your brains here a little bit too. So maybe like for all the audience, I'm sure like if one had this question, somebody else will have the same question. So what if the whole cost seg was not able to be done? Like what if the entire corpus was not be able to change for like this year, or and they will offset it next year? How does that work?
Tom, I don't know if I understood the question.
So he's saying that let's say you got $1 million in the negative K1, and you could only apply 400K out of that, and there is 600K left. Is that what you're
And then you
talking
say,
about?
can you does the losses
Well,
roll over?
what I mean to say is like if somebody put in like 100K in a syndication, and they're like, oh, you know what, the cost seg is going to be from 80% to maybe 100%, but
Mhm.
due to supply, demand, and chain supply issues and everything else, they're not able to do the whole thing this year. They're not able to do the whole rehab this year. They're not able to do the whole appliance change this year, or maybe the carpet change of blinds or whatever, or even
Well,
the
I mean,
exterior paint.
it starts from the time that it's installed. I mean, the
Is it?
time.
Yeah. Is it because a deal is closed? Is that what reflects the whole 100%? Is that how
Yeah.
it is? Right.
Mhm.
As far as I know, I mean,
Yeah,
that's
it could be the last day of the year. As long as you close within that year, you can take that
Okay.
bonus depreciation.
yeah, exactly.
Yeah.
Yeah. I
Yeah,
just wanted to
that's my
clarify some of the
understanding.
questions. Yeah.
And you
From
don't even have to,
somebody.
it's not like you're going in and doing any work actually.
Okay. Okay.
Yeah, you
That
don't
was
even
what I
have to
wanted to
do
ask.
anything. Yeah,
Yeah.
it's like the government is saying that, we understand that this property is going to deteriorate over a period of time, and
Mm-hmm.
which
Mhm.
actually does happen when you buy an asset
You have
over
to
a period of
replace
time.
it. Stuff has a
Yeah.
shelf life. Yeah.
Yeah, so there's
So if
shelf
you
life. Although we know that real estate never goes down in value, but government says it's going to depreciate, so we are going to help you out by taking that the
No, that's
advantage.
excellent point, because somebody asked me if the deal closed right before midnight, December 31st, 2022, would they still get 100%?
It's
And
totally
the
fine.
answer is yes, correct?
Yes, yes. The answer is yes. The other day I heard about some other investment called investing in old wine whiskey casks, and the government allows you to. I mean, I just thought it was interesting. It's called a wasted asset. The whiskey drops in like percentage of in the bottle. So in the same way, real estate, according to the government, although it doesn't go down in value, the government says it goes down in value. I mean, things are going to
Well, they
get
say that the
replaced.
physical structures go down in value because they do over time. A building has to
Yeah.
be replaced. The carpets need to be replaced over time. So yeah.
Oh, that's awesome point. That's
I think
awesome
this is
because
good. Yeah, I think this
yeah.
is good. I think we covered bonus depreciation pretty good here.
So
And,
bonus
and keep in
depreciation
mind
is
though,
good.
so like Noel said, it's the last year to do 100%
Yeah.
this year, and starting with next year it's going to come down to 80%, then it goes down to 60, like that, 20% per year.
So, guys, here's my message to you. If you're on the fence and you are really thinking about investing and you are like kind of like about a little bit more than halfway sure that you will be doing it and you are not sure if you want to do it this year or next year, trust me, if you do it this year, you will be a lot better off if you do it next year, because if you do it next year, you will be leaving money on the table.
Yeah,
Correct?
Yeah.
hundred
I think it's
percent.
80%. They're going to go down to 80%
Yeah.
for
So
bonus
so
depreciation
you
next
guys going to
year.
be leaving
This
20%
is the
of
last
that
year
on
for
the table.
100%. Yeah, there's only a few months
Yes.
left, 3 months left. Yeah.
All right.
All right.
So
What's
so
next,
the
Noel?
next so the next let's move on to the next one. So the next one it's a hot topic. Everybody wants to know about is 1031, right? 1031 exchange. And people are like, hey, if I sold a property, I had a small, fourplex or sixplex or whatever, if I want to take that money and put it in a syndication or vice versa or whatever. How does that work? Jonny, let's hear from you, since you've done a few.
What's that? You're asking about
1031, yeah, 1031 exchange.
Sure. So 1031 exchange is a very powerful tool. The government gives a essentially a tax write-off if you on all capital gains on the sale of a property, if you roll the funds, the gains into another property. Usually a larger, hopefully you get into a larger property. So for example, you buy a $100,000 building, right? 3 years later, you sell it for $500,000 and you make $400,000. Now, if you were to take that money into your pocket, the IRS is going to say, all right, well, we're going to have to ding you on the capital gains tax. You don't get hit with ordinary income tax, but you get hit with a capital gains tax, which is much lower than capital gains. But I think it's about 20 or 25 right now.
I think it's about 20 to 20. Yeah.
Yeah. And so on that 400,000, you would have to pay 25%, which is about $100,000. So you'd have to pay the tax man $100,000 on that gain, and you would get to keep 300 of that $400,000 gain. But the government says, you know what? You don't have to pay us that $100,000 in taxes right now. If you go and invest into another building, invest that money into another building, then you can take that 100 that turned to 500. You can take that full 500,000 and invest it into another property. What that does is now you've saved, now you have an extra $100,000 invested on this deal instead of taking the money right from the beginning, right? So people say, well, why does the government do this? Well, the government does this because this stimulates activity. This makes people that would otherwise just sit on a property like, hey, I don't want to ever sell this because I don't want to pay these huge capital gains taxes. But the government says, hey, you know what? You don't have to pay it. Anytime there's a transaction. So now this guy's like, well, I can take advantage of this. I can cash out my profit and go into another property. Now there's a sale. The broker gets paid, right? There's closing agents. There's buyers. There's economic activity. Somebody will buy it. They hire people to go and to do inspections and to do rehab. And then you spend money on rehab and you renovate and you hire people to do jobs to do that. So it stimulates economic activity. So what the government does is say, hey, listen, this is a way that you can save on capital gains taxes because it keeps the economy moving and going. So understanding where the government wants you to pay attention and where they want you to put a focus is very important. So that can save you a lot of money. So that is a way that you can sell. And you can do that again. So now I buy a $500,000 building and I sell it for $10 million. $500,000. Now I sell it for $1 million. Now I made another $500,000 that I can roll into another property and not pay any capital gains again. And you can keep doing this over and over. Every time you sell a property, you roll into another property, and you can never pay capital gains taxes. The only time you'll get paid the capital gains taxes is when you actually sell the property. So as long as you're not cash out, right? So yeah, that's essentially what.
So this is what all. Great point, right? This is what all these millionaires, the wealthy individuals do. They buy one property, make a killing on that, use that to buy the next property, keep on going, rinse and repeat. But here's the thing. The moment you sell, everything is recaptured, every depreciation you took. But there is a thing too. You don't need to sell. You keep on doing it. And when you well, when you pass away, you can pass it to your kids or your heirs on a thing called a step up
Stepped up basis,
basis,
yeah.
where they don't have to pay a single dime when they inherit that property. And this is how the wealth gets transferred from one being transferred in America from generation to generation, and they keep the building and they never sell.
So
There is
briefly
talk of
touching base
removing
on
that step up basis, but Biden
so
was talking.
briefly,
Biden was
just
saying
for
that.
the
Yeah.
audience.
Yeah.
So basically, we're kicking the can down the road. That's what it is,
Yeah.
right? I mean, at the end of the day, that's what's
Right.
happening. So for audience's sake, right? So for some of these new beginners that have joined our group, is there a time limitation? And secondly, it's this 1031, like, is like, we spoke about, like, if they sold like a property which is another kind, like a retail plaza, and then can they get into syndication, or can they get into like a multifamily? Is that a possibility?
Say, say that one
So
more
let's
time,
say
Noel. What was
so
that
let's say if
question?
I'm an investor, if I had, like, I owned a strip mall and I owned a strip plaza, and now I sold that, and now I want to do a 1031 exchange, can I put that towards a multifamily? Okay.
Absolutely. Yeah. You can buy property after property as long as it's commercial property. You can 1031 the
So
heck
is
out
that
of it.
what tenants
So
in common mean?
yeah, so yeah, exactly. So yeah, there's a so now that's very important what Noel just said. So let's say you owned the property and you made 5 million bucks. Now you're like, I don't want to do handle any more work. I want to
Uh-huh.
be a passive investor in a multi-family syndication. A syndication is simply where a bunch of people buy the building and they invite people to join them, and then you put the money, you get passive returns, right? So you're like, man, I made 5 million bucks. I'm good to go. I don't want to do the work that I did before in the
Hmm.
previous building. So let somebody else do the work, and I want to join the syndication. You can join the syndication as a roll over your 1031 into that syndication. You, as long as you just work with the general partners on that building, on that investment, let them know I'm coming in as a 1031, so they can structure that deal as
Excellent
tenants
point.
in common is what it's
Tenancy, I
called,
see. Yeah.
and allow you to come in. So because if you're going towards the end of the
Hmm.
syndication, towards when they're about closing, about a week before
Not gonna
closing, and
happen.
you walk in with the 1031 money, they may not, it may be too late. So you want to plan ahead. And
Yeah.
now this is a perfect time to
Exactly.
plan ahead before the end of the year. We only have 4 months left, right? I mean,
Three and a
three and a
half. Yeah.
half. So
So
yeah,
here's another ticker, guys. If you are a 1031 and you have a property you just sold or you're going to be selling, you know what? Definitely look out for these kind of deals. And you know what? If they can structure it for you, go for it, because after this, it's like you're going to lose out on those depreciation again. It goes back to the same thing, what we just spoke about. So they're kind of all tied up together a little bit, aren't they?
That's huge, though. I mean, I think that's really powerful. No, look, if you have a property that you're going to sell this year, sell it this year,
Yeah.
right? Invest in another deal, and then you can get the deduction
the
and get
Get
the
the
deduction.
money
deduction,
and get
right?
all of that.
It's
You
like
know, so
double
you can,
dipping almost, right?
all the
You
way.
don't have,
Yeah.
yeah, it's
If
double
you
dipping.
understand the tax laws, you can. There's no need to pay high taxes. That's what I'm starting to learn more and more and more. The more wealthy people I talk to, especially heavy real estate owners. I mean, if you know these these little rules can make the difference of
Yeah.
hundreds of thousands to millions of dollars over the course of your lifetime as an investor, and when you're investing in real estate and things like that. So this is definitely stuff that it's great to understand it, so that way you can utilize it, so you don't have to pay taxes. So you can pay less
Absolutely.
taxes. Right?
Absolutely.
Yeah.
Yeah, those are great points, guys. You know what? Now we're going to move on to our last one here. Let's talk about refi. Who wants to take a
That's a
jab at
great
this one?
that's a great segue, because I was just thinking of covering that, but then I was waiting for you. See, now let's say you're 1031ing a lot of you're 1031ing into another building, another, now like, where do I get my cash out, right?
Yeah.
All my cash is stuck in the building. That's where refinance comes in. So let's say you went and you 1031 into a building. Now you go to the bank and be like, you wait a couple of years, the building went up in value, maybe it accumulated 4 million in value. You go to the bank and say, hey, I bought this for 10 million, today it's worth 14 million. What's going on? Then the bank will be like, we could refi the building, and we could put the valuation at maybe 13 million. I know you like to exaggerate at 14 million, but we're going to put it as 13, and we're going to, guess what, we're going to give you 3 million of that back. That's called cash out refi. Means you're taking the money as a loan. So do you ever pay money? Do you ever pay taxes on a loan? You never do. So that's what Apple does. They have tons of money sitting in the bank, but they just go to Chase or all these big banks and say, hey, we need some money. We need about a couple $1 billion. Not because they don't have the money, so they can take that money, and they don't have to pay capital gains on the other money that's sitting in probably in China or in different places where they do business. They don't want to bring it into the United States and pay taxes. They just go to the bank, get the money. Same thing. You get a bunch of cash from the bank, refi it, pay zero taxes. As simple as that.
And what does a refi do? What does a refi do? It helps to pull the money out, all the money that we put it down as down payment, correct?
Even more, right?
It
could be even more. Yeah. That's the beauty of real estate is. And then guess what? You pulled out all the money that you put as down payment to buy the building, and you're getting cash flow every month. Now you don't have any money in the building, and the building is generating cash flow month after month for not only your generation, but for generations probably.
So just for the sake for the audience, let's run a quick example. Let's run $1 million property. Let's keep it small, right? So everybody can comprehend. So let's say if there's $1 million, we put in 300,000 as down payment, and then we finance 700K. Right? Now you guys have to help me out a little bit because I get brain frozen sometimes.
All right. So look, so now you have $700,000 of debt, right?
Yes.
You're saying, right? $300,000 of equity. We bought $1 million building. We've leveraged it up. We've leveraged $300,000 up. Now that building, over the course of, we change the operations. We buy a value add building that's mismanaged.
Yes.
The rent is, the rent is low compared to the market rent. We make the capital expenditures to make interior, exterior renovations. We change the operations. We make it more efficient. We bring and we increase the net operating income. And as a multiple of cap rate, the value of the building goes from $1 million to $2 million. Okay.
So hold it right there.
Yeah.
Pause.
Yes.
So you got $2 million because your NOI went up, your net operating income went up.
Correct.
It's not because of the neighborhood comps.
Doesn't matter what happens in the market. This is based completely on the income from the property, right? From the income going up, net income going up, which could be driving rents up as well as driving expenses down with increased operational efficiencies, systemizations, procedures, software, etc. Right? So, there's all types of ways to do it. But whatever it is, you're driving the net operating income, right? So now what happens is this $1 million building, just for the sake of, make it easy for calculation's sake, is now worth $2 million after 6 years, okay?
$2 million, okay.
$2 million. So now this was a good point that Thomas said, like, all right, well, if you don't get the gains and you keep kicking the can down the road, when do you actually get paid? When can I go buy a Ferrari or whatever it is that I want to buy with my passive income? Right? Dumb money is spent on dumb money, right? Dumb items that you buy should be done with passive income, right? Toys. So now this $2 million building, now we go to the bank and we say, hey, listen, we want fresh new debt on this building, but now the building based on the income is worth $2 million. The bank will look at that income, they'll look at the leases, they say, yep, you know what, we agree with your valuation, it's worth $2 million, and we will lend you 75% of $2 million, which is $1.5 million, right?
And
so now
only 300K in.
What's that?
We are only 300K in all this time, right?
Right. So now we're going to take that $1.5 million of new debt, and we're going to pay off. Let's say we paid only interest only on the $700,000. So we borrowed $700,000 when we bought the $1 million building at the beginning. We take that new $1.5 million, pay off the $700,000 of the first original debt, and now we have $800,000 of cash left over in our hand.
Jonny, say that again.
$300,000 was the down payment, and $500,000 is taken out of. Pulling equity out of the building as physical cash, and you're not paying any income tax on that money. And as Thomas said, that's how the wealthy Lamborghini. The wealthy
Let-
people borrow money
Yeah.
against themselves.
Hey, Johnny, let's repeat that one more time. Let's repeat that one more time. So we are 300,000 in,
Yes.
right?
Invested.
You went to the bank. Mr. Bank gave us 1.5 million.
Yes.
We paid off $700,000, right?
Yes. With the 700,000 was the
800
original
left.
loan, right?
And if there were investors in that 300K, we paid them off. They got the return of their capital.
So what would happen in that refinance if that situation happened where there was $800,000? That means investors are going to usually they're going to get their preferred return first. So they're going to get that all caught up if it hasn't been paid in the cash flows. And then second, they're going to get return of all of their invested capital. And that 300K that they invested, say it was 3 different doctors, say me, myself, you, and Thomas, we invested $100,000 each in this building. Now we're going to get back our $100,000 each.
One.
Plus that 500,000 that's left is now also split between the 3 of us at 100 and whatever it is. 500,000.
133.
Yes.
133. So 133 plus the cash flow, right?
No, it's more than that. Yeah.
Plus the cash flow that we got over the years.
Over the years.
And then we got our capital back.
All our money back. And nothing left in the deal. Yeah.
And how much taxes did we pay?
0 on that.
0. By the way, you're right. It's not 133, it's about 170 something. Yeah.
That's 500,000 tax free because it's a loan, right? So we're borrowing it against the property, but the property has the ability to service that debt depending on the debt service coverage ratio, right? So we borrowed 75% and the bank is lending, assuming that building produces enough cash that it can service the debt. If they can do that, then any other gains we take is tax free, and the building will pay it back. The tenants in the building will pay that money back.
And we still got 25% of value in the property and we still own it, correct?
Yep. And that's the money that you take and go and buy your Lamborghini, as somebody is in the comments saying Lamborghini time. Yeah, perfectly. You don't take the money that you earn and go and buy your Ferraris. You should invest your money.
That's the hardest thing.
And with the passive returns, go and buy whatever you want, because that investment will keep on producing returns every month.
Quick story, guys. I got to tell you about this because now we talked about the Ferrari and stupid money. Now I was stupid. Okay. When I was in school and I was at NYU and I was an Endodon resident, we'd been in school our whole life, delayed gratification, this, that. And, one of my friends, he planted the idea is like, when I graduate, I'm going to buy a Lamborghini. And I'm like, you know what? I'm going to buy a Ferrari. Now I'm rich because I'm a dentist. I'm an endodontist. I'm going to make excellent. And next thing you know, 2 years after graduating, probably 4th year after graduating, I went and bought a Ferrari. Cash. And I was like, wow, I'm the man now. But now when I look back, I know how dumb that was, because whatever money I paid for that Ferrari, I actually paid double for that. If I paid $200,000 for the Ferrari, that means I actually, in active income, which means money that I made doing dentistry, hard-earned work, and then endodontist, infected dentin flying everywhere. If that money is the hardest money to make, and I didn't pay $200,000 for that car, I paid $400,000 for that car because I taxed at such a high rate.
Absolutely.
Now, on the other hand, if I took that $500,000 out of real estate that I got on a cash out refinance, and then I went and bought that Ferrari $200,000 cash, I paid no taxes on that money.
But that wouldn't be fun, Johnny.
Yeah.
That wouldn't be fun. So, but tell
that's how Noel has a fleet of Ferraris with all.
It felt good, right? Hey, but here's the thing. I mean, like hindsight, everything looks like, you should have done this, you should have done that. But at the end of the day, this is what I'm saying. Like anybody, thinking about, you bought that Ferrari from that 60%, right? You paid 40% to Uncle Sam. But what I'm saying is, if anybody watching this now, had you watched this, Johnny, would you have done that Ferrari?
Now I know that
Yeah,
what I
yeah.
paid for that Ferrari, I buy 5 Ferraris today with that money.
No, I'm saying
Knowing what
like
I
if you
know
would have watched,
how to do the game of money now, you know?
yeah, if you would have watched this live chat that we're doing right now back
Oh
in those
man,
days, if somebody else, right? I mean, it would have been
I
a
wish
different
I had
outcome, right?
this when I was 2008,
I,
2009.
Yeah,
Honestly,
I wish somebody taught me this, man,
honestly,
when I
I
was in
went
my
through the school
20s.
of hard knocks, active invest. I've done all of this, you know, and it's like, there's a lot easier ways to multiply money. And it's
Yeah.
not, you don't have to, as dentists, as high income earners, we don't have to reinvent the wheel to become exceedingly wealthy by investing in real estate. I mean, we make that we already have a leg up on the vast majority of the population. We're top 1%, top 5%, top 10% earners in not just in the country and the entire planet. Right? So if all we have to do is be wise and prudent with our money, save a percentage of it. Make sure that you invest it in cash flowing assets that gives you tax advantages, and learn the tax game. Learn
from day one,
the investments that the wealthy people
day
do.
one.
You don't have to pay
That's
taxes.
the key. I mean, a lot of people like see what you said, like, just by making these small changes, your income, your net worth, not your income, but your net worth will go up like way higher, like 10x.
It starts
Because
to
a lot of
compound,
people,
honestly. Yeah.
yeah, a lot of people who are like dentists who are high earners, what do? They pay those huge taxes and then they go invest in stocks and crypto and all these because it's easy, right? It's
Which,
easy
and
to
there's
get
no
in
tax
and easy to get
advantages
out.
in those.
Yeah, and
Yeah.
guess what? You're getting taxed and you're doing these short-term trades and you made some money, but guess what? You're going to pay a ton of money in taxes.
Yeah.
And if you don't
See,
hold
guys,
for a
yeah,
year, you're going to pay like more, right? So that's why you should. I mean, real estate is like the perfect scenario. Not only you get passive returns, not only you get the tax advantages, not only your net worth is going up because of this, and so many advantages as a result of that. So I just wanted to say that a lot of people just go and buy a bunch of stocks or crypto, and then I know, but do you get these kind of tax advantages? No.
Yeah.
absolutely. Absolutely. And that's the thing where a lot of these guys, we are always thinking about how do we save, how do we put our money to work. So my message is very simple. Well, let's concentrate on our business first. Let's concentrate on our main thing first. Right? Now take that money instead of putting in crypto like Tom said. And Tom is well qualified because he still has some money in stocks and crypto, and he's taking a big hit. And I don't think
Yeah.
he's really happy
I,
about
I
it. But
haven't even I haven't even logged into my account in 3 or 4 months. I don't even want to just check that. That's how everybody is, not just me. Like I guarantee most people are like, but when it goes up, everybody's checking it. Oh my, I went up this much. I mean, but when I sell, I'm like, if I were to sell, everybody would say that it's a hard thing to sell because a tax bill is going to hit you soon.
That's the thing.
yeah,
Should we get to some of these questions here? There's a
yeah,
lot of
Yeah.
yeah. You know
questions
what?
here.
Let's do this here. Let's wrap this up for now. And I
Yeah,
think
yeah.
we spoke about the three advantages and the three strategies, right, for real estate. And let's do
There's
some Q
many,
and
many
A's.
more. We just picked 3 of the top big ones that a lot of people use to really
I see
not pay
somebody
taxes.
putting up, real estate professional status and all that stuff. We'll get to that in a little bit. And let's get
A
to the
lot
question.
of great questions, by the way. A lot of great questions
Yeah,
coming in today.
yeah.
All right. So one of them. You want to go,
Noel.
Johnny? Go for it. Go for it.
No, go ahead, Noel. You can wrap it up, man.
No, I'm
Okay,
just
all right.
reading the questions. Let's just do the questions. Go for it.
Questions? Sure.
Yeah.
All right. So question, there was one that said great stuff. There's thank you. Hold on, let me see if I can zoom up, roll up. There was one that said, from my understanding, real estate passive income deduction doesn't offset your ordinary income unless you have real estate professional title. It will only offset passive income, and phases are based on income. Yes, that's correct.
That's correct.
Yeah.
This is why you got to check with your accountant about it. And if you qualify and all that, it's a pretty gray line. So, but you need to confirm with your tax accountant about that.
Okay, and also welcome to Naud. Thanks for the tips. Kind regards from Ice Wallow, Canada. All right, I'm from Canada. I don't even know what that is.
All Cool.
Let's see. CVV always. Thank you so much. Wow, awesome. All right, General Dennis, beginner, very inspirational. Keep up the great work. Thank you for this wealth of knowledge. Thank you. Let's see the question here. Great stuff. Does it ever not make sense to do a cash out refi? What if the new interest rate is super high? That's an excellent question.
That's a great question.
Yeah, that's an excellent question. I would say yes. There's no hard and set rule that you should always cash out refinance. Absolutely not. I mean, if interest rates are super high, then it doesn't make sense unless the property can sustain it, the debt service. I mean, that's what it's complete. It's based completely on the metrics of the property itself. Can the property sustain the debt? Cover the debt? If it can, at whatever the interest, doesn't matter what the interest rate is, it just matters as can you service the debt and have a proper ratio of debt to income, right? So as long as you have that, it can be done. But your point is well taken. I mean, if your property is a 6% cap, but then the interest rates are 8% in a fully stabilized property, and there's no room for value add to bring that cap rate up, then you're at a negative leverage position. And that's, you never want to be in that position. So yes, there's absolutely times when you shouldn't cash out refinance. There's other times, maybe you don't want to incur more new debt. Maybe you're at a place in your career or life where you're like, listen, I'm 75. I only have 25% of the property is in debt. 75% is equity. Maybe I don't want to take it out. I'm just going to pass this on to my children as, on a stepped up basis for the value. I don't need to gut the equity from it. I don't need to cash out refinance. So it really depends on what your strategy is and what for the property and what you're gonna do with it.
That's a great question, though.
See, there's something I want to add there. There's a lot of ways there's a lot of parameters and a lot of factors that you look at. Number one is you have to look at where are you. That's why whenever we refi, we're giving a time frame of 3 to 5 years. We let the market dictate that, if the refi is going to happen or not, or if it's going to be sold. So it depends. Number two, it depends is where's the location of the property. I mean, is it in an area where it's going to be like high growth, high job, high influx, of landlord friendly? I mean, all these factors matter. Compression of cap rates. Where are we with cap rates? Does that cap rate and that interest rate, are they making sense? So there's not just one factor. It's really multifactorial. And like the past, we've seen like all the cap rates going down, but the interest rate went down. But now when the interest rate went up, the cap rates didn't really go that high. Okay.
Not yet.
I mean, not yet. It will eventually catch up, but we'll see. It has to be like really magnificent, like kind of milestone kind of hike from the feds. But there's so much factors, and every single day, every single month, I mean, things are changing. So great question. We just need to kind of like, reevaluate and see what's going to happen.
Yeah. I mean, all of these things are strategies, right? Cash refinance is just another tool belt in a real estate entrepreneur's, belt. So,
Yeah.
these are not things that you hard and fast, you use them all the time. It's as situations dictate. But, these are some of the ways that the wealthiest people don't pay taxes. There's a reason Donald Trump in 2016 paid $750 in taxes total. He paid $250 in tax, $750 in taxes the year before that as well. It's deductions. He gets all these rolling losses from his real estates that are passed on, and it compounds year after year because you can roll it over if you're not using it, and these losses become substantial. So these are all the big pluses of being a real estate investor. There's one person here, and forgive me, it doesn't show what the name is for the Facebook users, but it says, not always you can take capital losses in a taxable investment of stocks or bonds. This, I don't know. Stocks and bonds is not my arena. My understanding is that anytime you sell stocks or bonds, you incur taxes.
Yeah, even the losses that you take. I mean, he's right. You can take. I mean, based on my understanding, you can take only up to $3,000 a year. In losses. So which is nothing, right?
Yeah.
But then that kind of plays into the other argument is, what, are you speculating or are you calculating?
Yeah.
Yeah.
Exactly. Yeah. Oh, Big Joe. That's Big Joe from NYU. What's up, Big Joe? How are you, man? Good. Thanks for joining us. Endodonis also. Endodonis taking over here.
All right, NYU and NYU. Nice.
Akin, my man. I talked to him recently. Evelyn, thank you. Yeah. Yeah, that's it for the questions, I think. Anybody else have any questions? I think we're getting to the end here.
Yeah, just type them in the comments if there's any questions.
Any more? Yeah, please.
I guess that's hey, we are within the hour. Excellent. Love it. So this was a power, nuggets that we dropped, man. I mean, do you guys have any last minute thoughts? Tom, any last minute thoughts on taxes?
I think this real estate is a great tax play. Not only you enjoy the investments, the passive returns, but it helps you tremendously with taxes. Like the other dentist that we were talking to the other day, Noel, remember that she said it took her 3 years. Right now, she said, if I remember correctly, she said she almost pays zero taxes from all the investments. So that's where you want to be, but you got to start somewhere. And this is the way to do it. Yeah.
Absolutely. And you know what? And I've noticed, like, as time's going, like even like everybody else, even in our dentists, our physician groups, everyone is looking into like bigger and bigger deals, because that's where you can scale, that's where you can get massive tax advantages. It's not those little single family units.
Yeah.
And I've yet to see somebody going from multifamily going to single family units. I've yet to see that kind of transaction, but I've never seen anybody doing that. Last minute thoughts, Jonny.
Yeah, no, I mean, I think we covered it pretty good. I mean, there's obviously some other stuff people talked about, real estate professional status and QOs, qualified opportunity zones. We don't have time to go into all of that stuff. But what I do want to say is take home is it pays to pay attention on a macroeconomic level. And you have to pay attention on a macroeconomic level if you want to take full advantage of all the opportunities for saving money on taxes. The government will tell you where they want you to invest. All you have to do is pay attention. So government will give you all types of, listen, you don't have to pay taxes on this stuff. You don't have to pay taxes on that, as long as you do this. And it pays attention to do what the government wants. The government tells you where they want resources to flow, where they want jobs to flow, where they want capital markets to flow money. So if by going to those places, that's where you go and that's the way you go and save massively on taxes. Like we said at the beginning of this live, the biggest expense any dentist will pay, especially if you're a dentist, depending on dentist income, is taxes. And so invest heavily in real estate, invest heavily in things that can give you cash flows on a tax advantaged way, can give you gains in a tax advantaged way. And the more of your money that you make as a dentist, grinding every day, trying to make money, don't spend that money on the Rolex. Don't spend that money on that. Take as much of that as you can and flow it into assets that will grow wealth and gives you tax advantage dollars. That's the way, and that will cover your expenses. It will pay, you won't pay taxes. And that's the rapid way to get to wealth. Right.
And you know what, just to wrap it up, one other thing is real estate is a hedge against inflation, man. Inflation, invisible tax that we've never we're aware of. I mean, and
you want to touch on that, the invisible tax? We should talk. Yeah, that's a great thing you mentioned. Yeah.
I think that's a whole other topic, though, right?
That's a whole day. That's a whole hour right there, right? Invisible tax, which we now just let's put it this way: if you had $100,000 from 2018 or 2019 or 2020, and now today that $100,000 is worth how much, Tom? Probably 89, 85, 89.
Yeah,
right?
like yeah, probably.
So you know where the money's going now. If invested in real estate, you know where your money is now. So I mean, that's not even a question. So guys, 2022, last year. For cost seg, accelerated depreciation. Where do you want to stand? Do you want to leave money on the table, or do you want to take advantage of it? So you guys got what? September, October, November, December. Yep. You know what? Wait till the last 2 months or 3 months, and everyone will be looking for deals to park their money in and make sure, like, you know what, they get a full 100% of that bonus depreciation. So I would suggest, like, if you're on the fence, get on the other side of the fence. All right, guys. It was a good one.
All right.
Thanks, everybody.
All right, guys. Take care.